You see it everywhere. Headlines saying real estate bubble is popped. Real estate market's going to crash. And while yes, there is evidence of that happening, it's not the full truth. And if you're looking for a video talking about, why the market is crashing or what's causing it, blah, blah, this video is not it. So with that elephant out of the room, what I'm going to focus on this video is why, as an investor, I don't care about what's going to happen in the market and my plan for staying on top through this season. So when you look at the news or YouTube videos, all of these videos, if you watch them, they're talking about the real estate market from a very macroeconomic level, meaning they're looking at it from a nationwide perspective. And that's kind of unfair to do when you're looking at the real estate market specifically. The reason being is that the real estate market is very segmented, right? There's so many different individual markets that have individual unique characteristics about them. And to say that the overall market is crashing, it's just not true. For example, if we were to look inside of a city that you live in locally, can you think of a city or neighborhood where housing prices is completely different from the housing prices on the other side of that city? So how can we do that same thing on a nationwide scale? So yes, I get why the news and the media and why YouTubers might do this. It's because it's a good indicator of the overall market nationwide. But I believe there's a lot of unnecessary hype behind that. While I was doing my own research, I actually came across this one video that I really liked. It's by EPB Research, and he explains all of the leading indicators as to why he believes the housing market is going to crash. But in his video, he actually leans in on the worst markets that are being affected by this. But when you look at that same video, if you look at the other side of that graph that he provides, there are tons of markets that are barely affected by it. Some, 2-3%, maybe less than that. And that's completely normal in the ebb and flow of real estate markets. And so when you look at these videos, kind of read between the lines. Like, does this really affect you? Because it might not. When we look at this Fred graph comparing the national average to the San Francisco market to the Kansas City market, which is where I invest, you can see a huge drop when it comes to the real estate market in 2008 crash, right? So nationwide, yes, overall prices dropped. But when we look at the San Francisco market, it it dropped like a sack of bricks. But then when you compare that to the Kansas City market, it stayed relatively stable. If you look at the graph, it just goes horizontal. Maybe it dips down a little bit, but it's not too crazy. Now, of course, while the market was recovering, the San Francisco market recovered way faster than nationwide or in Kansas City. Now going into 2023, we can see that the market is starting to dip again, especially in San Francisco. There's another huge dip, whereas in nationwide, there's also a dip. But Kansas City, it actually still goes up a little bit, but it's not quite, well, the thing here is that we don't have enough information for the Kansas City market just yet. So it's unfair to say that it hasn't dipped yet in Kansas City. Up to Q3 of 2022, the market is still pretty stable in Kansas City when compared to the same time period in San Francisco or the rest of the nation for that matter. So that leads me to my first point of why I don't care about the market going into 2023. And reason number one is that I invest in a market that's just not going to be heavily affected by the downturn. Just because I say that I don't care, it does not mean I'm not paying attention. And so when market shifts, so does my strategy. Before we go even further, let's talk about the strategy that I use. And if you guys pay attention to Bigger Pockets, David Green and Brandon Turner, they talk about the BRRRR strategy all the time, or the BRRRR strategy. And what that stands for is the buy, renovate, rent, refinance, and repeat. And so what that means is that when I buy a property, I'm buying a property that's ugly, that's messed up, because I do the second thing, which is renovate it. So I'm buying it under market value and then renovating that property. And then from here, instead of what a flipper would do, they would just sell the property. My goal is long-term wealth growth, right? And to generate cash flow, to diversify my income and everything like that. So I actually keep it and I rent out the property to a tenant. And that tenant is going to pay me rent every month, hopefully. And that's going to help me make that cash flow. From there, I wait that 6 months that's required by all lenders, and I go to the bank and I do a cash out refinance. And when that happens, I now have this set amount of cash to go back and repeat it and buy another ugly property again. So now that you understand my overall strategy, what am I doing to tweak and adjust my strategy to make sure that I stay on top going into this new season? Well, the first thing I need to do is make sure that I'm estimating the future value of that property correctly. When the real estate market was hot, it was really easy to be correct about what that valuation was going to be. And so during the time of purchase, I might say, well, once I fix this property up and it's all good and pretty, the bank is going to appraise it for $120,000 today. But the fact is, it's not pretty today. I need to do the work to renovate it. I need to put the tenant in there. And 6 months down the line, I go to the bank and I say, hey, banker, I got this property. I paid this much for it. I put some renovation work into it. What is it worth today? And they're going to look at that property and they say, hey, it's worth $125,000. That's an extra $5,000 for myself. But going into this new downturn, I actually have to cut back on my future prediction. So if we're seeing a 1.5%, 2% decrease in sales prices in Kansas City, then I might go ahead and cut off 3 to 4% from my prediction, because once I buy the property, it's safe to assume that that property is going to continue to depreciate while I own that property and doing the renovations. And when I go to the bank, they're going to say, look at it from that point in time in the future, and that's what they're going to say that property is worth. So another thing I'm going to do is I'm going to go back to that banker and ask him, hey, where are interest rates at today? And where do you think they're going to be at 6 months down the line? And he might be like, oh, well, right now we're seeing 8 to 8.5% interest, and we're expecting the feds to increase the rate another 25 basis points every quarter or something like that. And so 6 months later, I might expect to see 8.5 to 9% interest. So if that's the case 6 months down the line, I'm going to run my numbers with that interest rate instead of whatever the interest rates are at today. And so when I run these numbers, I'm going to make my offer based off the lower future prediction of that value of that house and with the higher interest rate, so that I know when it comes time to talking to the bank to do that cash out refinance and getting that new mortgage, I've already built in where that valuation should be, if that makes sense. So going back to my strategy, I'm doing the BRRRR strategy, right? I'm buying ugly properties for under market value. I'm renovating those properties and bringing them up to market value and then renting it out. If the worst case scenario happens, I just need to cut my losses on the property and sell it right away, I just turn into a flipper, right? And once I'm done with that renovation, I'm going to do whatever I need to do to finish that renovation. I might go way over budget, and in the end, it'll just be a bad flip. I might lose some money. I might break even. Maybe I'll make a couple thousand, who knows? But that's the worst case scenario. And when you compare that to someone else who might buy a property that's fully fixed up, it's ready to go, and they pay full market value for that. Well, if we're seeing property values starting to decrease, the moment they buy it, next month it's already depreciated, and the month after that. We can get into that whether or not it's a good or bad thing, but I'm going to go into my reason number 2, why I don't care. It's because my investment strategy is very forgiving from the get-go. So I want to go back to that point I made earlier about buying a house at full market value during a downturn in housing prices, and why that's not that big of a deal. If you're like me, I'm investing for cash flow. I'm doing rental property investing. And if you're trying to get cash flow, it's not a short-term thing, right? We're holding on to it for a long time. The benefit of being a rental investor over any other real estate investing strategy, such as flipping or wholesaling, is that we make money in all 4 categories that you can in real estate investing. And so those four categories are appreciation, cash flow, tax benefits, and debt pay down by your tenants. And so when you're doing the BRRRR strategy, not only do you get market appreciation, you're getting that forced appreciation up front because you're doing that renovation work. And that's like the bread and butter for flippers. You're forcing appreciation into that property. But for a rental investor, one of the categories is appreciation. But if you buy a property at full market value and then it immediately starts to lose value, we still have the other three ways of making money in real estate. And another thing is that we are buy and hold investors. We're going to buy it and firmly grasp it. So even if that property does depreciate in the first year and into the second year even, it doesn't really matter. As long as you hold on to that property and continue to maintain it, you will eventually come on top. Meanwhile, you can still take the cash flow. You can still take advantage of the tax benefits that we have as property owners, and the tenant continues to pay down your own mortgage. And so once we get through that time of the market downturn, that first thing, the appreciation, will start to go up. So the longer you hold, the more and more the four categories of making money in real estate start to compound on each other. So reason 3 why I don't care is because I'm a buy and hold investor. I don't care what happens next year. I plan to hold on to this property through the recession and maybe even for an additional 2 to 3 years beyond that after I gain some appreciation and whatnot. Hey, before we continue, I got a quick message from my sponsor. Me, I am the sponsor of this video. If you're watching this video, this is my first YouTube video. Actually, that's a lie. I actually have other videos, but they didn't take off and I didn't stay consistent with it. But 2023 is the year I do want to consistently make content. I'm going to channel my inner Alex Hormozy and just take all of the knowledge, everything that I've learned from $0 to $2 million in portfolio value, and just create a ton of content for you guys. And just like Alex,
I have nothing to sell you.
I have nothing to sell you. And so with that being said, I do have several favors to ask of you guys. If you've got any value out of this video, please like this video. And if you like this video and you want to hear me flap my lips some more about real estate investing, then please subscribe. And if you have any questions pertaining to real estate investing, please leave it in the comments below, and I'll do my best to get back to you guys as soon as possible. And last but not least, share the wealth. If you know somebody else that you feel like can benefit from this video, please share it with them, send it to them. And that's it. Let's get back. So as my last and final point, I want to share a strategy that I'm going to add on top of my existing strategy. As I already shared with you, the BRRRR strategy, already a powerful strategy, but I'm going to add one more layer to that thing, and it's going to be seller financing. And if you're unfamiliar with seller financing, in a traditional house transaction, if you will, there are 3 parties, right? And we're going to simplify this down. 3 parties, there's a buyer, there's a seller, and then there's a bank in between us, right? As a buyer, for me, I have to give a down payment, and then I'm going to pay that bank every month, my mortgage, right, for the next 30 years. And from the seller's perspective, the bank is going to go ahead and give him that full amount, and that person can just walk away. In a seller financing perspective, we're going to take that bank out of the equation, and it's just going to be me, the buyer, and the seller. And so what I'm going to do is I'm going to talk to that seller and explain to him, hey, look, the market is starting to turn. You know, houses are staying on the market for longer and they aren't going as high as expected, but I would still like to offer you what you would like, or at least get as close as I can with it through a seller financing deal. For the seller, the benefit for them is that they get to get either everything that they're asking for or as close as possible. And the benefit for me is that I can put a little bit of money down, let's say $5,000, $10,000 down, and I'm able to negotiate the interest rate. If current market rates are at 8 to 9%, I can be like, hey, why don't I give you 4 to 5% interest rate and give me 3 to 5 years and I'll pay you back the full amount. And what that does is it buys me time to go and do the things I need to do. The seller can go off and collect monthly payments with interest from me every month. And they don't have to care about the property. Since I now own the property, I have to take care of it. I have to maintain it. I have to, whatever the tenant does, whatever damage that they do, it's my responsibility to repair that. And if I decide to be a bad person and stop paying, according to our contracts, he can actually foreclose on me and take the property back and he can do whatever he wants with it. He can sell it to another person, or he can become a landlord himself, whatever. In this situation, I create that win-win situation. The seller gets exactly what they're asking for. I get to get a lower interest rate, low down payment, and that 3 to 5 year buffer time for myself to do whatever I need to do. And so when the market inevitably turns back around, interest rates start to drop, property values go back up, I can go back to the bank and say, hey, I had this property. There's a current loan on it with the seller. I want to cash them out. I want to do a cash out refinance on this property. And the bank is going to just do the same thing from the BRRRR strategy, the refinance. They're going to appraise it. They're going to give me a great interest rate, whatever it is at that market rate, and that higher valuation because I held on to it for that amount of time. So anyways, that's it for me. That's what I'm going to do for 2023. I hope this brought value. I hope you learned something from it. If you like this video, please like, subscribe, hit that bell. If you have any questions for me, leave them in the comments below. And of course, share this video out with anyone who you believe could benefit from this video as well. Anyways, that's all from me. Peace.